Okay, so we've been watching the markets here. Investors are not only facing headline risk out of the Middle East, Russia, and China, but as we kick off the busiest earnings week of the third quarter, about 154 S&P 500 companies report. Any cracks in company foundations have the power to pummel the markets. So reporting this week, we can put up on the screen here, TD Ameritrade is after the bell today. Tomorrow, we've got Verizon, Lockheed Martin, McDonald's, and Corning. Wednesday is very busy. We've got Microsoft, AT&T, Whirlpool, and Visa on the calendar. And then you can carbo load for Thursday because it's Amazon, Alphabet, Intel, Twitter, and Snap. That's when they open the books. But my next guest says, iceberg dead ahead for the U.S. economy. Guggenheim Partners co-founder and global investment officer Scott Minerd is here first on Fox Business. What do you mean? You know, you put out a tweet saying the U.S. economy is the Titanic, and we know what happened there. The hull hit an iceberg, and that was the end of that. What do you see in your binoculars out there?
Well, you know, Liz, we're on this collision course. We got the tax cuts that have stimulated the economy in a big way. Of course, that's causing a lot of upward pressure in terms of wages associated as the unemployment rate continues to fall, which is causing the Federal Reserve to say, wait a minute, right? We have a mandate to have full employment and stable prices.
We've got full employment.
We've gone beyond full employment in their minds. We now have more jobs available than we have workers in the United States. And so it's
That's
just
a good thing, Scott. Isn't
well,
it a solid moment for the U.S. economy?
It's nice to hear for a change. I'll agree with you on that. But the reality is that the Fed's mandate is to continue to lean against the employment growth, to continue to lean against the price pressures, and they're just going to keep raising rates. And as they continue to raise rates, as we get into 2020, unless the president is successful at getting another tax cut through or we increase military spending, fiscal spending is actually going to become a drag on the economy. And so simultaneous with this slowdown in government spending, along with what is happening with the Federal Reserve, we're on a collision course, and this eventually is going to blow up on us.
All right. Well, it looks like the Federal Reserve is on its path, and it is not going to move away from it. It wants to continue to raise rates. You just saw 84% chance of another rate hike in December. That's the Fed funds futures.
Right.
As we put up what you see here, there are a couple of things that you see as sort of these icebergs. The trade wars, which I would say are so far a little spotty when you talk about, is it really hurting companies? Today, yes, we heard from Polaris and Indian Motorcycles. They're saying these sanctions and tariffs are killing us. General Motors has said it hurt. But are you expecting that there will be more of a meaningful group of businesses that suddenly say, we got to lay people off because these trade wars are hurting us enough?
Well, I think as time goes on, look, I think we still have time. You know, the worst of the trade wars hasn't hit us yet. The president is going to be meeting with...
okay, that's a headline. The worst of the trade wars has not hit us yet.
That's right.
We believe that.
Right. And, you know, the president is going to have an opportunity to meet with the premier of China on the sidelines at the G20. So I'm not going to completely say that we've, you know, had a full-scale trade war. But if we continue down the path, then what we're going to see is what happened in washing machines. There was a tariff placed on washing machines back in the spring.
First
right.
tariff.
And it was a 20% tariff on washing machines.
Foreign washing machines coming into the U.S.
Right. But washing machine prices in the United States are up by 20%. So people say, who's going to pay for these tariffs? It's the U.S. consumer.
Well, that goes back to what even Larry Kudlow, who is now the president's econo head, used to say. Mr. President, tariffs are a tax on the American people.
Right.
But why, when you combine that with your second issue, which is, of course, a ballooning deficit,
right.
And the news came out last week that the deficit for 2018 was $779 billion, highest in 6 years, up 17% year over year. Are we not getting enough in corporate tax receipts? They are at 75-year lows. Mick Mulvaney, the budget director, had just said last week that inspired growth from the tax cuts will save us all.
Well,
you don't believe that?
I don't believe it, because let's go back to the washing machine example. If tariffs continue to push prices up, it's going to cause the Federal Reserve to become more aggressive raising rates. And so what the president has delivered in tax cuts could very well be taken back by the central bank. And they see that as their jobs based upon the dual mandate they were given by Congress.
Well, then, are you saying that President Trump is correct when he beats up on Jay Powell, the head of the Federal Reserve, and says, stop raising rates, you're going to derail a very strong economy?
Well, I think there are two things to say about it. If Powell's going to fulfill his mandate to maintain price stability, he's going to have to raise rates. That is just a structural issue in the United States economy. The president is not wrong. Rate increases are going to derail the economy. And inevitably, this collision is going to come.
Rate increases are going to derail the economy.
Right.
What do you do then? How do you invest? You've got $200+ billion in assets at Guggenheim. You're the chief investment officer globally. Where are you putting your clients' money?
Well, I bought some of the Mega Millions lottery tickets the other day, but that was for myself.
Great.
But on a more serious note, I think this is a good time to take some money off the table. I had been calling for a setback in the stock market in October. We've gotten it. I think near term, this is a buying opportunity.
And you're
we'll
saying
go higher. But
this amazes me. Buy Tencent Holdings. Tencent is this gigantic Chinese conglomerate.
Right.
But the Chinese economy is getting hurt. Their stock market is down 30% for the year. And Tencent's high was $61, and it's in the 30s right now.
Well, I always like to buy stocks on sale.
Yeah, well, that's a smart thing.
Right. But, you look at the earnings of Tencent. We're trading at a multiple of around 35, 36 times earnings on Tencent. You look at Amazon, we're trading at almost 200 times earnings. And the growth rate for both companies' earnings is about the same. So, yes, we have a near-term storm with the Chinese, but I think that storm is a good time to look at things that are out of fashion and get in on things that are still cheap.
Because Fortnite, oh man, my 14-year-old loves that game, and they own Epic Games, and that's all Tencent. Scott, will you come back again?
I'll always love to.
Okay, but I don't want to see the Titanic. I don't want to see the economy turn into that, but we'll see what happens.
Well, thanks for having me.
Thanks so much. Scott Minerd of Guggenheim Partners, by the way, one of the most widely followed on Wall Street.